Good day and welcome to Letters and Politics. I'm Mitch Jeserich. The Organization for Economic Cooperation and Development has reported that recent increases in global inflation have reached their highest rate since 2008. The United States inflation increased at an annual rate to 4.2% in April from 2.6% in March. Undoubtedly, this raises concerns for many as people want to know how far will the dollars go. How expensive will it be to live? Well, for a conversation on inflation, we are joined by Robert Pollin. He is a distinguished professor of economics and co-director of the Political Economy Research Institute at the University of Massachusetts-Amherst. He's the author of a number of books. His latest, he co-authored with Noam Chomsky. It's called Climate Crisis and the Global Green New Deal, the Political Economy of Saving the Planet. He joins us via Zoom. Robert Pollin, always a great pleasure, sir, to have you on this radio program. Thank you for taking the time.
Thank you very much for having me, Mitch.
As I was saying in the introduction, inflation's scary. People want to know how far their dollars are going to go and are always concerned about what savings or whatever they may have is shrinking rapidly due to inflation. How concerned are you? How concerned do you think people should be in this moment?
I think that we should always be concerned about inflation. Inflation can be destructive if it gets to very high levels. By the same token, we should also be concerned about deflation, about prices going too low, because that happens in a depression or a serious recession. So as you noted, Mitch, the current inflation rate for April, just for the month of April, was pretty high at 4.2%. For the year overall, the inflation rate is going to be lower than that, but the 1 month rate at 4.2%, let's say, is concerning. But the main factor driving it is one thing, and that's oil prices. Oil prices over the last year have gone up by over 40%, and that's driving the inflation rate. Now, the reason that oil prices have gone up so much is because they had gone down so much last year. In fact, a year ago at this time, oil companies actually, the price of crude oil was negative. They actually had to pay people to take oil to get rid of their inventory. So relative to that situation, of course, we expect the price of oil to go up significantly relative to negative, and that is pushing the whole overall economy's inflation rate at the moment, and that should stabilize.
There are a number of things I want to unpack there with you. One is about the price of oil, and I just suspect that people have seen memes, especially from sort of Trump supporters out there online, talking about the price of oil between Donald Trump in his presidency and last year, and the price of oil now with the Joe Biden presidency. And these memes that point to the difference being is the president. Who is president have any role in the price of oil today?
No. What's driving the price of oil and what drove it last year was that last year we were in a severe recession. Nobody wanted to fly on airplanes, so there was no demand for oil. Travel in general was contracted. People were not commuting to work, so that the demand to buy gasoline, to buy fuel oil for airplanes was close to zero. I mean, it was actually unprecedented. And that's why, truly unprecedented. Right before your show, I looked on April 20th last year, the price of crude oil was negative $37. In other words, the oil companies had to pay people $37 a barrel to give away the oil to get rid of their inventory. So naturally, as the economy is recovering and we are coming out of the COVID recession, the demand for oil is going up. So therefore, the price is going up. And keep in mind, the fact that the price is going up is not the same as meaning that the price is high. Historically, the price of oil, crude oil, is where it was about 3 years ago. It was higher 3 years ago. But the increases are what's driving the current inflation rate.
Is it increases in the price of oil that will naturally bring inflation generally?
Well, oil is an important factor in the overall economy. So just like in the 1970s, when we had the so-called oil shocks with the Organization of Petroleum States, OPEC, jacked up the price of oil, doubled it in 1973, doubled it again in 1979. We had a decade or more of persistently high inflation, because if the price of oil goes up by 50%, that is going to feed into a lot of things. It's going to feed into all of our transportation. It's going to feed into fuel oil prices. Those things then feed into consumer prices. So that's the main thing driving the inflation, overall inflation, from what it was around 2%, say 3 months ago, to the current 4%.
What has the role, do you think, been on the money that has been put into the economy by the government in order to try to alleviate some of the economic hardships caused by the pandemic? This isn't just Biden, but latest round came from, well, at least was signed by President Joe Biden, $1.9 trillion. But of course, there were trillions of dollars that were allocated before that in the previous year. Is that playing a role in inflation at the moment?
Yeah, it is. In this sense, yes, as you said, the first stimulus was March of 2020. So that was under Trump, and that was in the range of $2 trillion then. So that was very, very large. On top of that, the Federal Reserve pumped in over the course of the last year about $4 trillion into Wall Street. So that propped up share prices, stocks. Then Trump signed a second bill, $900 billion, in December. So the Biden bill in March, the American Rescue Plan, was the third of the three stimulus packages. Now, yeah, the main thing they did was counteract a collapse of the economy. So we don't want deflation. We don't want prices going down. I mean, if prices going down means that all financial institutions basically are going to get wiped out. So that was prevented, and that's good. So we do want at least some moderate inflation. Is a lot better than deflation. I mean, imagine the oil companies. How long could they have survived paying people $37 to buy a barrel of oil? So we do have this pressure, and on top of it, there is some, this adjustment into the post-COVID recession economy of getting people back to work. And so you do have to pay people decent wages. And so people, at least for a couple of months, are to some extent waiting. They're using the funds that they're getting from the government to hold out for a month or two. That's all it's all going to last another month or two. And so that's pushing up wages moderately, and that's contributing to inflation. But that's good, because wages have been stagnant for 40 years. So if we have moderate upward pressure, if people are getting slightly better wages, I take that as a positive.
How confident are you, though, that the increases in wages will keep at the rate of the increase of inflation, which for the common worker, and you've done a lot of work on this over the last 40 years, it has not? That's
right. So for 40 years, wages have been stagnant. They've been much lower than the productivity of the economy. In other words, how much a worker produces in a day has more than doubled. The average wage has stayed flat after we factor in inflation. So whether wages can go up faster than inflation in the future will really depend on how well labor organizing goes, whether workers have bargaining power, and if we have a growing economy, workers will have more power to bargain, and that will enable them to raise their wages. And it should be that the wages can go up faster than the inflation rate, especially once the oil price stabilizes. I would just mention also, with respect to the oil price, if we shift into thinking about the green economy, raising energy efficiency standards, substituting renewable energy for fossil fuel energy, that will permanently reduce demand for fossil fuel energy and therefore reduce the price.
Biden administration officials expressed that they believe that this rise in inflation will taper off here shortly. You seem to agree with that.
Nobody knows for sure ever, including the Biden administration, including any Nobel Prize winning economists that you may line up. But I think the likelihood is that we've had a big push coming out of the COVID recession. The economy is recovering, so we would expect prices to rise. And then we have this special feature that the oil economy was so severely hit during the COVID recession that we have the oil prices going up very, very quickly now.
This is Letters in Politics, and we are in conversation with Robert Pollin, Distinguished Professor of Economics and Co-Director of the Political Economy Research Institute at the University of Massachusetts-Amherst. He is the author of the book, the co-author of the book with Noam Chomsky, Climate Crisis and the Global Green New Deal, the Political Economy of Saving the Planet. I think people are used to seeing the fluctuating prices in gas. But as a shopper, I know when I go to the grocery store, and I can't say I'm paying that much attention. I view it more as a chore, and I'm doing it half asleep, basically, not that conscious of it. But I don't ever remember seeing, my peanut butter has gone down a dollar or two in price. So those seem to only go up. I mean, if prices are going up now, can we expect general prices also to go down if inflation tapers up?
I think that, we've had this experience over basically the last decade of very, very low inflation, 1.5%, 2%, which is probably lower than it should be for a healthy economy. If in a healthy economy where wages actually are going up as they should, the wages going up should push businesses to try to cover their costs by increasing their prices. And that's how you get inflation. The key thing is, though, that the workers' wages go up faster than the businesses' prices. So that's really the dynamic. And so if you have 2 to 3% inflation in a growing economy, that reflects, in my opinion, a healthy economy. That's fine. So if your peanut butter is going up by 2% a year, you should say, great, that means that people's wages are probably going up, the people that are producing the peanut butter. It's when you get...
Sure, my wages are going up.
Too. Are you? Good.
No, they're not. That's my point. No, that's my point.
Well, that's what you need to bargain on. If you come to look, I mean, I'm doing work for various unions. I can't say their names, but on their bargaining right now. In fact, it's one of the biggest union contracts in the country coming right up. And yes, we're very concerned that we measure what exactly the inflation rate would be as relevant for the workers in this union, because we need to get their wages above by 1.5% to 2%. So that's kind of the basis of the wage bargaining. Okay, so the wage should go up by X, let's say 2%, above the consumer price index, above the inflation rate. So if the inflation rate is 2%, then your wages should go up by 3.5%, 4%. That would be the standard. And that's something that should be consistent also with an economy where productivity is going up. Again, productivity means how big the pie is. And if the pie is going up by 2%, that means your wages should at least be going up by 2% just for you to keep your share of the pie. If your wages go up by less than 2%, that means your business owner is getting a bigger share of the pie and you're getting a smaller share.
How did this work in the years after the New Deal and after the Great Depression?
So, in the Great Depression, of course, we had deflation. That's part of prices went down. And what they wanted, how can we start getting prices coming back up? That was the question. And so really World War II is what brought the US economy and the world economy out of the Depression. And that was really a process of the government just spending gigantic amounts of money. The government spending was 25% of the economy. And as a result, government borrowing was 25% of the economy. Government spending was like 40% of the economy. So prices did go up, and there were shortages. And if the economy grows quickly after having been dormant, like it was Depression to World War II, and like we are today, COVID recession to getting out of it, there are going to be shortages and bottlenecks because things just weren't happening, and workers got laid off. So to bring them back, even just as a matter of course, it doesn't happen in one day. It happens over a couple of months. So there's going to be shortages, and things are going to go up, just like they did, as in your example, transitioning to World War II from the Depression.
Yeah, I think just what scares people about inflation, if prices go up but my salary goes up, then not really a problem. As long as they're on par, maybe I'd like my salary even to go up a little bit more. That would be ideal. But I think what scares people is prices going up and salaries not going up.
Yeah, and that you should be very concerned about. So then, how do we address that? Well, if we look historically, generally wages, let's say up until the mid 1970s, wages were going up faster than inflation, and were going up more or less in step and with productivity. So people's living standards rose. So if we take the period, say from the end of World War II to the mid 70s, to the oil shocks, there was inflation, but inflation was corresponding to a growing economy with rising living standards. So inflation per se is not the problem. So the problem in the 70s started with the oil shocks. And at that point, the oil prices pulled up the overall inflation rate faster than people's wages. And that's how we came up with this new term called stagflation. So you had a stagnating economy with rising prices. So that was something we definitely need to avoid. And, the only thing that's ever caused stagflation is these very rapid prices of oil. And if you don't have these rapid prices of oil, and we have relatively decent bargaining for workers and decent working conditions and labor laws, wages should be going up faster than average prices.
So there's people with wages who are concerned about inflation, want to make sure their wages at least stay at the rate of inflation. And then there's people who are on fixed incomes, people who, survive off Social Security checks or off pension checks, retirement checks.
Yeah. So Social Security is indexed to inflation, meaning that the Social Security payments will go up exactly in step with the inflation rate. A lot of pensions are as well, not all. And so that is something that, we haven't thought about too much because inflation has been so low for so long. In general, if you have, let's say you don't have a pension indexed to inflation, at the very least, you have a pension manager who's doing investments, and the investments should be yielding incomes that are at least rising at the inflation rate. If they're not rising even at the inflation rate, then you've got a really bad pension manager. And you had a bad pension manager in low inflation times too.
I just want to be very clear about our dynamic here. I'm coming to you as somebody who's like almost, what's happening? Worried, and you're trying to talk me down a little bit.
Yeah, I'm trying to talk you down.
but there's another thing I want to ask you about this is fear over inflation a potential driver of inflation itself? So in other words, perhaps I have some savings, but I think my savings is going to be less valuable in the near future. So I'm going to start spending that money right now. That can actually get into the cycle and help fuel the cycle of inflation.
Well, yeah, I would say I'm not your investment advisor, just let's declare that. But I would say if you have your savings, let's say in a checking account that's earning zero interest, Therefore, the value of your savings is going down at the inflation rate. So, next year, whatever you have, $100,000 is going to be worth $96,000 with a 4% inflation rate. I would say, even at your bank, you probably can buy a CD that is going to at least match the rate of inflation. So that's the way to protect yourself against inflation. There are a lot of ways, simple ways, index funds, money market funds that at least yield income levels, returns that are going to be at the inflation rate.
Do you think this will be a test for Keynesian style economics after putting and pumping all this money into the economy? This is what critics of such moves have warned would happen, is that inflation would come and it would make all this money meaningless.
Well, we're not at that point meaningless. Meaningless happened, in Germany in 1923, where you had inflation rates of, 1,000%, or in Bolivia in the 1980s. I actually worked on the Bolivian economy post hyperinflation. So we're nowhere near that world. Again, historically, other than these hyperinflations, which are generally tied to wars, or these oil shock inflations, moderate inflation has been associated with a healthy economy, a growing economy, because it reflects workers pushing up their wages. And so historically, if you look at the relationship between inflation, economic growth, and living standards, inflation in the range of 2, 3, 4% is generally associated with people getting better off. I've looked at that for many, many countries, and I'm not the only one, of course, who has looked at it. But that still does mean that we need to have the institutions and the mechanisms to defend people, to support people like yourself. Like if you have your money in a zero return checking account, well, put it in a 3% return account, and you should be able to do that easily. If you can't do it easily, then your bank isn't doing its job for you. So go to a different bank. Over time, this will be an adjustment. But keep in mind, we've just come out of this deflation experience, which is worse. Half the people in the whole country, 2/3 of the people in California, filed for unemployment insurance between March 2020 and March 2021. I mean, this is more severe than the Great Depression. It wasn't as long, but in terms of the intensity of the downturn and the deflation, oil prices being negative $40 almost, that's something that, you can say what Keynesian or the stimulus has been hugely successful in preventing this from causing an all-out economic collapse.
So what we're experiencing now, we're almost out of time here, but what we're experiencing now is kind of to be expected.
It's to be expected. It's worrying. Anyone, like I said, anyone who doesn't worry about it a little bit isn't paying attention. On the other hand, it's a lot better to have this problem than the one we had a year ago, where half the country was, facing unemployment and the oil price was negative $40.
Robert Pollin has joined us for a conversation about inflation. Robert Pollin is Distinguished Professor of Economics and co-director of the Political Economy Research Institute at the University of Massachusetts-Amherst. He's the author of the book, along with Noam Chomsky, Climate Crisis and the Global Green New Deal, The Political Economy of Saving the Planet. Robert Pollin, thank you. Thank you for walking me back from the...
Okay, good, Mitch. Good. Whenever you need investment advice, I'm available.
We'll do it on the radio. The best.
Okay. All right. Thanks.